that's kind of the bigger idea. It's Lloyd's of London, but scaled up for the internet age. And Lloyd's, again, is just a marketplace. It's a pot of money. It has 103 different insurance companies that sit on top of it that specialize in everything from like nuclear risks to aviation and space risks and property risks of every sort. That's how you get to insane scale, I think. It is kind of decompose this so that and decentralize it in such a way that's accessible to every other sophisticated reinsurer in the world.
Nothing said on the Edge podcast is a recommendation to buy or sell tokens or securities. This content is for educational and entertainment purposes only. Nothing shared here is financial advice.
Welcome to the Edge podcast. I'm DeFi Dad here with Nomatic. Today's show features Karn Saroya, the co-founder and CEO of Re. Karn, thank you for joining us. How are you doing?
I'm great, gents. Thanks for having me.
When I think of Re is a platform to give us all access to this Gatekept yield opportunity that is reinsurance. And so if you've never learned about reinsurance, this will be a great walkthrough to better understand how it works and why the yield is real and why that yield is so powerful when packaged through the Re platform. I think it's a great example, too, of a regulated fintech that has the DeFi mullet set up. So where DeFi is ultimately powering the back end and the whole global capital pool of lenders. Karn, why don't we get started with more about what you were building prior to Re? You've been in insurance or reinsurance for longer than the start of Re. I think this is a part of the moat behind Re. You can't just set up a DeFi protocol and start selling reinsurance. There's a regulated component to the Re protocol. So anyways, tell us more about what you were doing before.
Yeah, for sure. I don't think insurance is known to be the sexiest thing, but I've been in it for a while, right? I'm now coming up on, I think, year 12 of building technology into the insurance space. And I, like other technologists and folks who have built into a variety of these different spaces that they perhaps didn't have expertise in, started off relatively naively, right? Like I didn't know anything about insurance. I was in my 20s. I pitched Y Combinator on an idea behind an insurance app that took a picture of something and got folks insurance. Just kind of simplifying the entire consumer experience behind buying coverage for your house, for your car, for your pets, just about anything you could visualize. And again, myself and my co-founders, who are actually the same co-founders that have come over to Re, didn't have prior experience in distributing, underwriting, pricing, or working through the mechanics of like matching risk to capital in the insurance market. We got hard and fast lessons. Within a couple of weeks of launching out of YC, Apple featured us as a best new app. We were seeing tens of thousands of people send us pictures of their wedding rings, their cars, their homes, their pets. In San Francisco, we saw pictures of tanks that were being sent to Burning Man, and just about anything that you could think of was coming in the door. And so the consumer behavior was really surprising to us. We needed to figure out how to match those requests for insurance to ultimately people who could provide that insurance. And so we were just desperately picking up the phone, calling brokerages and agencies around the country, asking them to take on these customers who we clearly couldn't provide insurance to, and routing the customers. And so what we quickly learned was there's a significant disconnect between how people wanted to buy insurance and ultimately how they were receiving it. And so agents would take weeks to get back to folks. It was really, really slow. Drop off would be significant. And so we ended up building a national insurance agency from scratch. And so in 50 states, we distributed products for all sorts of insurance companies. And I got a good flavor for what direct-to-consumer acquisition looked like for insurance. Again, we fell into the same kind of trap of the software that underpinned most insurance companies is pretty archaic. If you guys have, in recent memory, tried to buy insurance on the internet, oftentimes are kind of punted to a call center. And so there's like very few of these opportunities that are like very seamless. And so we're like, okay, well, we see tens of thousands of people coming in a day to buy insurance from us via our apps. Why don't we go build an insurance product ourselves? And so we're moving from like pure distribution to now like, what are the guts of actually building an insurance company, getting regulators on board, getting balance sheet capacity, the money that's needed to go write insurance happening. And as part of that process, got really good at building out kind of the functions of an insurer, hired on folks who had run publicly traded insurance companies, importantly, interact with the reinsurance brokers and reinsurers. So we had the capacity to go write insurance business. And so been kind of one of the few people on earth that have kind of stood up an insurer from scratch, and then also made the bridge directly into DeFi. And I think of those few people, most of the people are on our team at this point. So yeah, all of this to say that they've seen everything from top to bottom in insurance, all the way from distribution to now this risk transfer business. Yeah,
I think that really resonates with me. Just what you said about getting insurance is just not the smoothest thing that you'll do. Like from car insurance, home insurance, business insurance, it's never really fun. And I think most people listening to this probably understand insurance. It's just part of our lives. Like we've grown up, you have to do it pretty much. But I think very few understand the term reinsurance. So I want you to try to explain reinsurance, from a first principles basis. Why does it exist? And why has it become such an important part of the global financial system, really without many people knowing even what it is?
Yeah, for sure. So I'll use a very solid example, right? Like, let's say a tree falls over, destroys some part of your roof, your home. You have a home insurance policy. You have been paying insurance premiums to your insurance company. That insurance company, in turn, has made a promise to pay if certain things happen. Right? As part and parcel to that promise to pay needs to come proof that they can pay. Right? So you've been paying in premiums. They've been investing those premiums. They've been earning a profit. Is the money still around? Right? And so what reinsurance is actually a financial backstop and guarantee that the insurance company is going to be good for the money that it owes to its policyholders, right? So the insurance company itself is going to have a balance sheet. It'll have a pot of money that it pays claims from. If those claims exceed that pot of money, or for a specific like program or across the board, the reinsurer steps in and is now part and parcel of this transaction. So as a result, the insurance company is actually paying premiums to the reinsurer. We are an insurance company for insurance companies at the end of the day.
Ultimately, you're telling us then that the major retail-facing insurance companies that we all might have worked with, like State Farm, for example, you're saying that if their losses exceed whatever their model predicts that coverage to be for, they ultimately have this fallback plan.
That's correct. And so it may not be purely the case that it's an excess of loss type of deal. It might just be the case that you're an insurance executive and you've made the determination that you're too concentrated in a particular region, or you want to grow more quickly and you need more money to be able to do that. Reinsurance is effectively a capital market in the insurance market. And so you could go write the insurance business, go write the policies, and then offload those insurance policies and the associated risk of those insurance policies to a reinsurance partner or a panel of reinsurance partners. It's like additional diversification and a means by which the insurance company can grow.
Karn, how big is that addressable market for reinsurance?
Yeah, it's massive. I mean, it's $1 trillion. There are 2,000 admitted insurance companies across the United States. There's a step function more than that across the world that support. There's $1 trillion, and there's $7.5 trillion of insurance premium that's written across the entire insurance market. And then there are all these other collateral markets that are basically predicated on: do you have money to fulfill the promises that you make out in the world? These are letters of credit, so trusts that are pledged to all sorts of commercial purposes. And you end up looking at like nearly 15% of the global economy is related to just showing people that you have the collateral necessary to make the promises that you've made out in the real world, right? It's a huge part of the global economy.
Okay, so we know what reinsurance is now. We know how big the market is. I think you're saying there's $1 trillion of premiums done a year for reinsurance. I think the next question is, why bring it on chain? So, we've seen treasury bills get tokenized, private credit get tokenized. Now it's happening with reinsurance, but why is this attractive to bring your business, which you've toiled away at insurance for years, but why bring it on chain and why now?
In DeFi, yield shouldn't come from chasing dashboards or timing markets. KPK runs non-custodial vaults and on-chain funds built for stable, risk-adjusted returns. Capital is allocated across curated strategies and managed by automated agents that act within seconds under predefined controls. No custody, no manual intervention, just disciplined execution on-chain. If you're allocating capital and want sustainable yield with stronger controls, visit kpk.io. The next generation of transparent dollar yield is here. Axis brings you 8 years of institutional experience providing global liquidity, generating durable returns. By synchronizing prices and liquidity worldwide, Axis captures delta-neutral opportunities without directional risk. Deposit into Axis to improve global liquidity and earn 10 to 20% net APY. Over 1,800 unique wallets committed $67 million to the Origin Vault. Stay tuned for the next phase and learn more at axis.to. Apex is the first dividend-backed stablecoin protocol, bringing enhanced public market yield on-chain, backed by Strategy's perpetual preferred stock, Stretch. With APY USD, anyone can earn dividend-driven real yield live on Ethereum. To learn more, go to apyx.fi.
Yeah, so we were talking about Nexus and other folks who had tried this in prior instances, tried to bring insurance on chain in the past, and the reason for it is actually kind of like, if you're a step back as just an insurance executive, it slaps you in the face really quickly how analogous the insurance business is to like the basic function of DeFi and blockchains. Like, we are literally saying, here's a contract that pays out under specific conditions. Here are the triggers, right? Here is the money that pays out under those specific conditions. You can analogize that to smart contracts. You can analogize that to, the basic staking of crypto economic assets against adverse developments out into the future. And so in some sense, like, a lot of what happens on chain is actually insurance. And it made sense to me to find a vector of attack that bridged the gap between the two. And I think where folks have stumbled or had at least challenges in scaling is, rather than trying to bring like a archaic conservative business like insurance on chain and forcing people who've been doing business the way they've been doing business for 70 years, 80 years, in some instances hundreds of years, onto this new architecture, like, why not bring the things that DeFi are specific things around composability, transparency around the underlying, capital flows, capital verification. Why not bring those things directly to the insurance market, right? Like, what these guys still require capital to run their businesses. There's capital on chain. So that seemed to me like the path of least resistance. And that's proved out to be the case, right? Like, what we're seeing now is we have 51 different reinsurance treaties across the United States that are using digital assets to support insurers across the country. 30-ish insurance companies, $500 million in business, going at $1 billion in business. It is not a startup. It's not a toy anymore. It's really at the inflection point where this zooms, right, to tens of billions in premium over the course of the near midterm. And that means the implication is that digital assets are going to be supporting tens of millions of business owners, people trying to get to work, people trying to buy homes, people driving across the country and ostensibly the rest of the world. That's massive, and it's plumbing, right? It's not super obvious. It's kind of just now it's going to end up being foundational.
Re is such a good example of what we refer to as the DeFi mullet, and I think what you're describing as this permissionless capital pool that is ultimately powering re, like that is the operational efficiency unlocked. That's capital efficiency unlocked. Can you just talk more though about like what does that mean for the re business? Like, are you this much more profitable because of the way that you're able to raise capital from lenders on chain versus the way that traditional reinsurance companies would ultimately raise money?
Yeah, for sure. So then in two parts, right? I think one, we are very privileged to be able to start a de novo reinsurer from scratch without legacy systems and legacy business. Like we don't have clients that go back 150 years and send us reports scratched onto like a tablet, right? It's that we need to make sense of. Everything is kind of new. And so we don't necessarily need the same sort of headcount to do all of the back office work and the back office reconciliation of all of this information that's coming from hundreds or if not thousands of customers with all sorts of different reporting. That's a really big drag for traditional insurance, for traditional reinsurers and insurers that we just don't need to deal with. The second part is we get to build this at a technology inflection point that squashes basically and solves really, really cleanly the problem of taking unstructured data in every form, structuring it, normalizing it, drawing inference from it, and using thinking computers to help like price risk, sit within an underwriting box, do the work, assign the capital, do the reporting. All that stuff is now been made possible by LLMs over the course of the last couple of years, and we sit at the frontier of that. We get to take full advantage of that. And the way that manifests is like right now, today, we're still subscale at $500 million, but we write roughly 10 times as much premium per head per employee than a traditional reinsurer. That's probably going to end up looking like 50x over the next little while. And so if you think about what are the expenses associated with provisioning reinsurance or insurance, they're going to get squashed. It's going to become an increasingly small part of the overall kind of economic stack. And then the next question is going to be, how much granular control do you have over your cost of capital, which is the other part of this product, right? You need collateral to go write insurance business. And now what you have is you have these like dynamic capital pools that can grow, that can pay, that can be tranched, that can be tokenized. You can create secondary market liquidity in the manner that we have, that are just far superior to what exists in insurance today, which is a static pot that's governed by a couple of insurance executives that say, hey, here are the risks we're going to attach to it. And by the way, my bonus is predicated on how much of this capital I can sit around, even if I can't deploy it correctly. You now have an audience and depositors who demand a particular yield and want the verifiability and the transparency around what's happening with that underlying capital. And you that's just a higher standard actually than exists for the traditional insurance market. So fundamentally different architecture, I think, way, way, way higher operating leverage. If you zoom back a little bit, this is just kind of like Tesla being able to stamp out Model Ys at lower marginal cost than any other auto manufacturer. We're literally just able to stamp out the product of reinsurance at lower marginal cost than any other reinsurer in the world. What does that mean over time? It means that if you just survive, you win the market, right? And that's the sufficient condition, actually.
I just want to linger on this point for just a second, because I really think this is kind of like the whole ball game right here, what you're talking about. I think this is why things move on chain, this efficiency you're talking about, this low head count. I think before we get on, I think you're under 12 employees at Re. And, to scale your business to billions, I don't think it requires you to need to hire like hundreds of people, right? What kind of revenue per head is this right now? And I guess to grow your business to billions, like, do you maybe answer that question? Like, do you need to scale up a lot, or does this stay like kind of lean and efficient?
Yeah. So we're at 12. You're right. It's about 30 million per head today. So we're profitable, which is great. I think that it probably understates the efficiency. I think in the near term, you're probably going to be double that, maybe more. Where I focus my energy is actually there's clearly a need for some redundancy right? 12 is pretty thin still. And so like we're working on making sure we have redundant capabilities on the technical and product and design front. A lot of my energy is now spent on identifying reinsurance and insurance folks that have the muscles that are necessary for us to scale into the rest of the market, right? Like I'm thinking about, I'm not thinking about $1 billion because we're going to get there, right? I'm thinking about how do we get to 5? How do we get to 10 billion? And who are the folks with the expertise that's locked in their heads that we can pair with technologists to be able to enable this crazy growth, right? That's where I spend my time. And even that doesn't mean more than a dozen people, actually, right? It means like, look at the top 100 people in the reinsurance market. It kind of filter for energy, enthusiasm around technology, a vision for the future that involves digital assets, and you start to whittle down that number pretty quickly, right? And once you've got the core, you pay for that core, and you've got and you monitor kind of performance, and you go on from there. So I don't think that this gets for the piece that's the reinsurance piece doesn't get to more than a couple dozen. I think if we expand the scope of what we're doing, so if you have this programmable capital lake, and you have all this software that's built on top of it for insurance companies and underwriters around the world to be able to access, you have a clean segue into, hey, like there should probably be an effort, and maybe it's us, maybe it's not us, to go build an AI underwriting compatible stack. Like there should be AI enabled insurance companies sitting on top of programmable capital. That's my vision for kind of where this is going to go. And what does that mean? Like very specifically, it means like Einstein is literally going to take in all the information that's necessary to get you insurance, right? Is going to come back and say, here's exactly what your coverages are. Like here's your house, here your assets need to be covered. You've got kids, you need life insurance. You've got a small business. You need umbrella policy to go with that. Here's exactly what your risks are. Here's how you need to hedge those things. Here's a package I put together, and I provisioned the capital from an insurance company, printed exactly the policy that you needed, and provision the capital on chain to be able to support that. So you have comfort that if anything does happen, you're good for it. Like the insurance is good for it. That's going to happen, right? It's not going to be Marsha or Kevin or your whoever it is that's going to be thinking about this every year and not have a fulsome view of who you are, what your business is. It's going to be in real time. What are the risks that you face? How are those hedged? And what are the instruments that have been provisioned to hedge those risks for you? That's the future.
I'm curious for the reinsurance buyers, your customers. Are these folks that are ultimately, buying coverage from you? Are they similar to, like, I guess how some of us would operate with, mortgage rates, like pending reputation and a bunch of other factors there, of course, and knowing that they can do business with you as a newer reinsurance company? I mean, if you're able to offer rates that are just 10, 20 bips lower, is it that much of a magnet for new customers to re?
Yeah, so we actually have not started to compete on price, right? And so a lot of the excess economics have just kind of internalized for to the benefit of re and depositors and the rest. And so that piece is certainly a switch that we could flip at some scale. If you just spin off tons of cash and you want to send it, and you're willing to pay the insurance company, or at least lower your rates such that the insurance company takes more of the pot, you're going to win more business. There's no question about that. There are channel conflict challenges because a lot of this business is brokered that kind of make that less effective than we would otherwise have assumed in a perfectly efficient market. Because it's a brokered market, there's an agency problem, and there's a whole bunch of other stuff that comes out of that. Though that will not change in kind of my viewpoint. Where we really win is we post capital to the insurance company itself, right? So we're fully collateralizing our obligation. So if things happen, the insurance company knows that the money is there. It's there. A traditional reinsurer, a rated reinsurer, signs a piece of paper and says we're good for it. Our auditors on an annual cadence say we're good for it. We don't necessarily have real-time attestation to our ability to pay, and you're not going to have a very good understanding of what the rest of the risks are that we take. Right? Sorry. And so what we've argued is cash in hand is way better. Complete verifiability around what risks that this capital pool is taking is better. Speed is way, way better, right? So if we can get back to you in half an hour when someone else would take 2 or 3 weeks to get back to you, we're going to win way, way more deals, right? And so you speak their language, you use the same rails to conduct business as they've always conducted. You find the highest performing folks in the space that they respect, that they want to transact with, show that the capital is there, and go on from there. That's been the winning strategy. It's like, don't innovate too much on kind of forcing change, because forcing consumer change or businesses to change their behaviors is not an errand or a battle that you want to fight. You just want to meet them where they want to be met and do everything better. Right? Like that's literally it.
I want to just reiterate a few things that you've called out. Just listening to you talk and trying to conceptualize how re is winning in the reinsurance game. So it's clearly efficiencies, way lower headcounts, things like that. It sounds like another differentiator you said is traditional reinsurance outfits don't really always prove that they have the capital ready at hand. They kind of give you don't worry, we got you. So that's another one. You can sit on this capital base that is ready, in whenever it's needed. And then another one is just everything that you're doing is fully auditable in virtually real time. And people get that peace of mind, again, that, hey, this money is going to be ready when you need it. What else would you fill in the gaps here on anything else that you see as how you're disrupting the status quo of the reinsurance model?
Yeah. So again, we don't want to make our customers uncomfortable, right? Like they've done business a particular way. Everything else is kind of the internal machinations of a reinsurer are just being refactored. So anything that would have required a couple, if you think about what this business says, is some information is captured up front. People are trying to make a determination as to hey, what they should charge you to cover claims and expenses. Should you make a claim, and how do we deliver a profit margin? At the end of the day, that's what this is. There's no tangible good. It's an intangible product, and it's a contract. Computers are going to be able to rationalize basically every single step of that, with the exception of potentially the human relationship of selling insurance. Some people are just going to want to talk to a person, and it's not going to be a chat bot. That will become increasingly a smaller part of the market as we move forward and into these future decades, but all of it's getting rationalized. Our point of view is that's we just build for that inevitable future. I don't think that there are that many insurance executives in the world that are we should just set up on top of a verifiable capital lake endpoints for agents to be able to tap capital, right? Send us information, tap capital, get it provisioned. So it's kind of hey, build for the architecture that you think is going to happen, that you think is going to be inevitable, and be prepared for it. That's basically it. Do it as few high leverage people as you possibly can do it, and you get further than you expect. That's kind of the lesson here.
Karn, can you start to walk us through what does the capital stack look like? There are two offerings that we've referred to before, which is REUSD and REUSDE. And then there's actually a third pool of capital, which for me was the light bulb moment when I was learning about re, understanding that I'm not the junior tranche in either one of the first two I mentioned. So anyways, talk us through how does that all work, and who's senior, who's junior, and so forth.
Yeah, for sure. So the kind of the critical thing to getting all of this to work is incentive alignment, right? Everyone talks about incentive alignment. And it's well, for our purposes, we've got all of our assets tied up as first loss, right? So we've got this massive safety pool, which is our assets, it's earned premium, it's our equity, that eats any sort of volatility in the underlying insurance portfolio first, right? And so we can credibly say that if we win, you win. If we lose, you probably are still going to win, right? And so this layer ends up being kind of the shock absorber ahead of all the stablecoin tranches that we've kind of set up. And so massive pool, that will end up being inevitably larger than the size of any sort of insurance or safety pool for any stablecoin or DeFi product, period. This is going to be very, very large. In fact, I think right now it probably rivals, if not exceeds, the size of the safety pool for Athena and for the Sky ecosystem. And we are pretty subscale. Above that, we have a mezzanine layer that has quarterly redemptions that are actuarially gated. It takes on some insurance risk, and you make the trade-off between liquidity and kind of the yield that you earn and risk remoteness. Above that, we have re.USD, which is a senior over-collateralized tranche that is which has at least a 50% holdback for redemptions at any given moment in time. That's the product that is getting most widely integrated, across borrow lend and approvals with curators and the like. And so as you kind of move up the stack, you get increasingly remote from insurance risk and you get increasingly liquid. All of this to say, the way we've cracked this nut is like, we're the duration, right? Like at the end of the day, right? And so you couple us being the duration plus these liquidity sleeves, and you've now got a machine that makes sense, right? For current DeFi architecture.
Karn, so you mentioned the different durations of these different assets, and something we've seen in the space that's been killing protocols is this duration mismatch. I feel like it stems from when a protocol maybe doesn't educate users well enough on, hey, look, these are duration assets that have certain redemption criteria. We've seen some protocols, I think, sell a bit of bill of goods to people, and then all of a sudden everybody wants to redeem, and they're like, wait, I can't. Or there's not DEX liquidity. How have you been navigating this with re.USD? Because I believe that's a quarterly redemption vehicle. Just speak to this a bit, because I think it's a huge kind of issue or problem in our industry, and would love to hear how Re's been navigating that.
Yeah, for sure. So look, I think I kind of enumerated this already, but our own assets are predominantly the duration, right? Like they're locked. They're the ones that are absorbing most of the insurance risk. re.USD is a mezzanine layer that's still protected by all of our assets and by our equity. The re.USD product is intended to be made available and released as the actually determined collateral can be released, right? And so as you move up the stack towards re.USD, you get increasingly higher levels of liquidity, and commensurately you get paid more. Like depending on where you are on the stack, you get paid a certain spread that reflects the illiquidity risk, right? And so you're right that you can just literally look at what cash we have sitting around, our ability to service redemptions and pay. Some part of it is going to be encumbered, the vast majority of our own assets, to the purposes of meeting something called a minimum regulatory capital requirement, right? And so that's the number that ultimately we have to meet. It's like, what does the regulator say we have to have? And what does the customer say we have to have as collateral? And theoretically, everything else is redeemed above that stack, right? And so we are doing our best to make sure that if we enumerate every single deal we're party to, what the capital requirements of those deals look like, and folks can kind of formulate an opinion about where they want to sit. But ultimately, you get paid a higher spread for the illiquidity and the quarterly redemption cadence. I think you guys had pointed out, like, hey, folks could simply step in and purchase these products should they ever trade at a discount. The answer is, like, there are huge hedge funds that already do stuff like this, right? There's Stone Ridge that makes an entire business of this, knowing that there's significant capital protection kind of sitting downstream of that, and it's a timing thing. But of all the RWAs, I think we're probably the best positioned to be able to kind of solve for this, right? Like, we spin off tons of cash. This is a business that generates a lot of free cash flow. You can see kind of all of it coming in. You can see all the deal flow coming in. There's a predictable pattern of collateral release. Like, we know that if you sell an insurance policy January 1st, it earns in over the year, right? As it earns it over the year, the risk is gone. Collateral can come out the door. If you sell a policy December 31st, it's going to be earn over the following year. It's going to follow a similar pattern. And so you can kind of approximate, what the collateral needs are for this in a way that's kind of not disconnected from what the underlying business is, right? And so before we saw any capital formation, we spent like nearly a year educating kind of allocators on exactly how, these cash flow patterns worked in reinsurance, what the underlying risk was, what the protections were that were in place. And importantly, the only way that we got this to work at all was like, hey, we'll put up our own money and a lot of it, right? In order for the rest of this machinery to work. So yeah, that's been our solution at the end of the day. It's just like, hey, we know what the minimum capital requirement is. Theoretically, the rest of it is releasable, starting with REUSD, then the mezz, then finally it's our own capital, which is not moving anywhere, right?
Karn, when you mention your capital, as in, I think you're referring to that junior pool, how much money is in that? And then do you know, like, what is the approximate yield that junior pool of your capital that's ultimately, earning yield versus we have REUSD that's most senior, that's earning, I believe, about 6.3% as of this recording, and REUSD is earning about 12.3%. I'm just trying to understand like the difference here. And is that all the fees that Re takes ultimately? Is there other fees for like doing all of the BD of ultimately, getting reinsurance clients and doing all the underwriting and so forth?
Yeah, the only fee that's charged today is a redemption fee of like 6 bips. We are probably going to end up getting rid of most of that too. So there aren't any like there's no rake on like kind of the spread or what have you. It's just, we have a defined fixed spread for the senior layer. We have a defined fixed spread for the mezzanine layer. The junior capital tranche, right now with earned premium and equity, I think it sits around 80 million, right? Something like that. And that the return on equity for that sits at about the market return on equity. So it fluctuates depending on kind of where the market's at. But right now the reinsurance market is like mid-teens, low 20s. That's where it's at.
One thing we spoke of before we started rolling is, when you talk about that massive piece of junior capital that you have sitting there, that to me is a moat. So, if somebody were to say, hey, this reinsurance business onchain looks really good, let me get into that, or I'm going to fork a protocol. To me, there's a lot of impediments, I think, to that this traditional behavior that we've seen in DeFi is just, if something's working, you see like 10 or 20 of them crop up. But that massive pool of capital you have, I think, is a big impediment to that. And I just want to get into this because there's really not many other protocols doing what you're doing. There's another one out there, but I'm just kind of curious, how you think you're differentiating yourself from other competitors that we might see come into the space or that already are in the space. What separates, Re from other people that are seeing this and want a piece?
Yeah, for sure. Look, I think this is an incredibly difficult business to execute, right? Like, you have to navigate DeFi, you have to navigate a regulated insurance market, you have to get the customer to ultimately buy the product. That's the insurance company that's buying the insurance from us, which is a dance, right? And so like along 3 of these things, you have to execute perfectly to scale, right? And so there's no copy paste version of this, right? Like, you're not going to be able to like just say, hey, Re did this and now we're going to go stand this thing up. You have to execute on 3 different fronts and 3 different businesses in order to make this work, which is a huge moat, right? Like, it's just difficult. We are the only ones in the market that have shown that we have the ability to scale, right? So like, we're whitelisted with every reinsurance broker of note in the world, right? So like all 5 of the top 5, 8 of the top 10. We are actively doing business directly with insurance companies across the country, and those relationships are deepening and the sizes of our deals are going up. And the execution has been exceptional, right, in that front, in a way that we haven't seen anywhere else in this market. On the DeFi front, also like the quick ramp up to a couple $100 million deposits, there's really no reason why this should not be a multi-billion-dollar kind of like TVL product over time, right? Like, it is tapping into a yield source that is near infinite, that is completely uncorrelated, relatively predictable, and folks can focus on like as we mature in kind of this market cycle and mature in kind of the understanding of what this business is, should be a no-brainer in my mind. Not financial advice, none of this, right? But this is just from my objective chair looking at this and looking at the rest of the overall DeFi market. The other important thing here is like we have indexed aggressively towards conservatism to start, right? So like when we're out there and we say we have all of these assets as first loss, we do. There's nobody else with assets that sizable in first loss in this market. When we say that we're low volatility, that is true. All of our business is low limit, low volatility lines of insurance business across the United States. This is auto insurance. This is home insurance. This is small business, commercial insurance. This is certain parts of workers' compensation. There's no floods. There's no fires. There's no hurricanes. If they are in there, they're de minimis and they're fully funded by the economics that we charge. And so there's no circumstance here where you have a binary outcome, right? Like if a hurricane hits Florida, we're not going to show up and say, oh, we lost all of your money, because that's not the type of business that we write, right? And so for our current state of the business, that makes complete sense. Like I think if we hit a multi-billion run rate business, I think it makes sense for us to titrate in more of the overall insurance market. And you have these higher margin, higher volatility little pieces of the overall portfolio, as opposed to kind of make that your bread and butter, which I think is like difficult. Like it's tough because I don't know that many people really understand the types of risks that they'd be taking if those are the products that they were buying. And so that's a differentiation, arc towards conservatism, first loss, complete incentive alignment, and an exceptional execution on just getting the insurance market to accept us, right? Which is, we're still one of one there.
I know we've made you restate this a few times, but the thing that has really been shocking for me to better understand is that junior pool acting as a first loss protection. There's $80 million in re that is ultimately there as like a shield for me as an LP in, let's say, REUSD or REUSDE. So I've been thinking, for some time, like, I mean, part of the reason, again, we do these podcasts is we're doing research out in the open. We are, sometimes like actively looking to deploy, our own capital into certain DeFi protocols. And, I, like a lot of lenders, I'm tired of earning, T-bill rates, and DeFi's taken a lot of hits this year. And so this mashup of what re offers as a regulated sort of fintech with a DeFi mullet backend, but offering that reinsurance yield, that's huge to me. So anyways, just reinforcing, is that the best way to think about it? There's $80 million there that's acting as a first loss cushion.
Yeah, it's first loss for insurance risk, because most people, let's be candid, right? There are very few humans on earth that know how to underwrite insurance risk, right? And so like to ask an LP to be like, figure out how this book should perform and like, think about where you want us in the stack becomes a little easier if you say you're the one to take the first hit, right? And not just take the first hit to a significant extent. And so that's been the innovation here, right? Is like get the market comfortable and scaling. There may be a future here where folks are able to take a junior position. It's very possible, but we just don't think the market is there yet because there aren't that many people that want to underwrite insurance risk.
Karn, another question for you. I don't know if I'm just like injecting something here or if all this like AI sort of hoopla and hype is bleeding into my thoughts too much. But, I've seen countless, on podcasts or interviews or what have you, where some smart guy is just like, yeah, there's just not even enough capital for the AI build out. We need more money. We just don't have enough money. And I look at, reinsurance, a capital intensive industry. I'm wondering if there's any bleed over from this, massive suction of capital that's happening in AI that's like where dollars are becoming harder to come by for your business, just seeing this like once in a generation build out that's happening.
Puffer is building the ultimate vertical in crypto. Your crypto deserves better yields. Better yields require better infrastructure, and Puffer is building it. Puffer Liquid Staking delivers above-market ETH yields, secured with up to $5 billion in slashing penalty protection and buffer. Puffer Institutional offers compliant, secure, above-market ETH yields for DATs, institutions, and large players. Puffer Unify is the first synchronously composable rollup, enabling the next generation of app chains on Ethereum with sub-10 millisecond transactions. Unify AVS enables pre-confirmations, making Ethereum validators more profitable and rollups more scalable. Puffer is premier infrastructure and yield for digital assets. Stake your ETH at app.puffer.fi.
Yeah, we haven't seen that actually, and so I think they're actually quite disconnected from a financing perspective, right? Like just in some sense, they're both kind of like secured lending to some extent, but the performance of 100 million insurance policies moving in any given direction, it like converges to predictable economics really, really quickly. It's a law of large numbers business, right? You have a relatively more nascent GPU and data center financing opportunity, which is important and I think should be funded. But the market is going to clear on what the acceptable market price is. It's going to clear on how much capacity should ultimately end up getting built. I think animal spirits are in play, and whether we are overbuilding or underbuilding, I'm probably not the right person to say. I think more compute is generally a better thing, but what the appropriate price and funding structure of that, I think, will leave to kind of the machinations of the market. But all of this to say, like, there isn't that much crossover. To the extent that there is some crossover, these data center buildouts and GPUs are looking for insurance, right? So like builder's risk. And from what I've seen, folks look at it as kind of like any other shiny new object. There's a ton of capital from a reinsurance perspective that is now moving to secure these risks. Whether it is appropriately priced or not, we do not have a position because we don't do that business. Right? I think if I were a guessing or betting man, I would argue that because it's a shiny new thing, the risk is probably underpriced. Right? Is my guess.
Yeah, sounds like you're not in the reinsurance of like AI data centers or the insurance policies that back them. I do want to talk about another, I think, major thesis underpinning the growth of DeFi, which is real world assets. We're seeing lots and lots of new protocols and exciting headlines about, tokenizing real world assets. Where do you think RE fits into the broader RWA movement?
Yeah, so I mean, it's an asset class. Insurance is one of the largest financial markets in the world, right? And so it could end up being a very sizable part, right? Like, there's no reason why the capital is tied up in every insurance company and every insurer in the world needs to be little pots and little silos. I think all of it could end up being represented on chain, and it improves this market massively. And that is like trillions of dollars, right? This is like an order of magnitude greater than the overall stable coin market. But that's to say, like, as we grow up, the rest of the market's going to grow up, and you're probably going to still end up with kind of a similar ratio of where the dollars end up, right? And so, like, could insurance and reinsurance be 10 to 15% of all of DeFi at scale DeFi, right? When everything else is scaled? I think so, right? Like, there's really no reason why that wouldn't be the case. The unique feature of insurance and reinsurance is that it's actually a natural capital formation vehicle, right? So, like, as opposed to requiring retail demand or institutional demand to generate stables or digital assets, insurance or reinsurance ends up being an engine for that formation. So I'll give you an example, right? Like, you stick $1 of collateral in an account, you can now write $4 or $5 of insurance business. Where does that $4 or $5 go, right? That could find its way back into stables that sit in a trust account, that could find its way into other digital assets that earn a return in a transparent way. It ends up being a force multiplier on kind of the aggregate amount of digital assets that are out there floating in a way that very few RWAs can do.
I promise I don't just ask AI questions, but I have another AI question for you. I like that segment earlier when you were talking about these agentic underwriters, and I just want to get into that a little bit more. I'm curious, just how much RE yourselves are exploring this avenue, and okay, we've been talking about this agentic wave on this podcast for years now, and it hasn't happened yet, but I do feel like we're always on the verge of it, and I feel like we're even more on the verge of it now than ever before. But yeah, just speak to a bit more how that's going to change your business and ultimately probably your industry going forward here.
Yeah, so we use agents internally to do all sorts of things, right? To take in data, to conduct actuarial analysis, to do write-ups on underwriting, to make recommendations on capital provisioning. Like a lot of that stuff's already happening with us at the reinsurance level. Where I think, where I think that actually is more effective is a step above us, the insurance companies themselves, right? So my stylized example would be there's a CFO of a company, let's just call it mid-market, maybe it's S&P 500. They have products out in the world. They need product liability insurance. They have executives. They need directors and officer insurance, E&O, errors and emissions, all the types of things that you would need typically if you're running a business. Now, the future of today, they would go to a traditional reinsurance broker on an annual cadence. They would come in and do a presentation and say, here are the risks of your business, and like, here's your run rate, and like, here's all the insurance that you need to buy. We'll go out and shop it for you. Happens again on an annual cadence. The future is literally that CFO is interacting with super intelligent thinking computers that already have access to payroll, their enterprise resource planning, everything else that gives that computer a fulsome view of what that business is, how it's performing, and what the risks are. It's then going to figure out, what do I need to hedge? Like, what are the existential risks to this business? Like, do I need product liability in case my products, are faulty in some way and I get a class action lawsuit? Like, how do I cover off that particular risk? So it's going to come up with, here are all these risks. Here are the coverage levels that are appropriate for the size and scale of your business as of today. Here's what it's going to look like as you grow, according to what your growth plan is. I'm going to print you an insurance policy that stipulates exactly what these coverages are, and then I'm going to provision with an insurance company and a reinsurer the capital that's necessary to back it, and you're good. And not only that, you're good for the entire future, because I'm going to reshop this at every interval where there's a meaningful change to the underlying business, all real time, right? And so that is like a massive change, because what I just described is like 30 cents on the dollar in insurance. 30 cents on the dollar is the expense load, the origination load, reg and taxes, and everything else that actually doesn't come back into the pocket of the policyholder. That's going to get squashed. Right? And so my specific vector of attack is like, well, build the layer that shows shows where the capital is and how the money moves, and then start to think about how to interact with these things that are going to pop up in the future. I can already use these tools to make my operations much more streamlined. I think that the massive effectiveness is going to come upstream of us. That's kind of where my head is at on this.
So Karn, you have a dashboard at app.re.xyz/metrics. This is a dashboard that we've been tracking just to understand, like, how is Re growing? Are you successful? Can you talk us through what are the metrics that are most meaningful to you, and what is indicative of, again, Re being successful as a protocol and growing?
Yeah, for sure. So, I think you've got all the traditional DeFi metrics, so you can see the metrics dash and kind of where the cash is. But like, if you want to decompose this down to like how is this thing actually performing, and like how is it going to be as a going concern? What matters are these two numbers: the total premium written, and ultimately what the treaty performance is. And so you can actually see on a line-by-line basis exactly what insurance deals have been written. And what you would want to track is you want to track book loss ratio and combined ratio, which we publish. What you want is a combined ratio that is in the 90s and the 80s, implying profit is being generated, and that the entire thing is self-sufficient, i.e., depositors are going to be paid, the capital is going to be paid. That, for me, that's the North Star. It's literally, are we making money on the insurance, and is the insurance business growing?
When you say treaty, just for folks that aren't familiar with that term in reinsurance, what does that mean?
So it's not different from your own policy, right? Like, so if you bought a home insurance policy, a treaty would just be that, but like on steroids, right? It would be tens of thousands of homes, or hundreds of thousands of policyholders. It would just be a big block of risk as opposed to an individual policy.
One more, could you go back up to the top of your dashboard? There's a metric that I had been digging into before. I was on Claude trying to better understand this. Premium receivable, what does that mean, and how is that indicative of the growth of Re?
Yeah, so this is a number that's related to deals that have been inked, and what you would see is on a monthly or quarterly cadence, insurance companies sending us that premium. So the reinsurance premium receivable is going to end up being earned and end up as capital that's available, right, and sitting in trust. That's what's going to happen. So the receivable number, it's actually going to continue to grow because we're still writing more business, but you'll see more cash flow into RE itself over time. So that's an important number. It's an indication that the business is still growing. The other thing that's really important to note is we don't post collateral until we receive money from insurance companies, right? So there's no credit risk or credit mismatch there.
Karn, as we wrap up here, just talking about growth, I'm curious what you think is needed for hundreds of billions of insurance capital start to move on chain. What are the bottlenecks to that future playing out?
Yeah, so this is a kind of neat segue into the protocol function itself, right? So Re Labs owns a regulated reinsurer, right? It provides capacity, it puts up its assets and equity. It is the first client of a protocol that forms capital to this purpose. If you want to skip from us writing 5 or 10 billion to the entirety of the reinsurance market, what we need to do is find a way, and we are, because we're building it for our own client, to be able to plug this capital into any underwriter, or reinsurer, or insurance company in the world seamlessly, right? Just because we're one client of this thing doesn't mean that we can't have ostensibly thousands of other clients around the world, right? And that's kind of the bigger idea. It's Lloyd's of London, but scaled up for the internet age. And Lloyd's, again, is just a marketplace. It's a pot of money. It has 103 different insurance companies that sit on top of it that specialize in everything from nuclear risks to aviation and space risks and property risks of every sort. That's how you get to insane scale, I think. It is kind of decompose this and decentralize it in such a way that's accessible to every other sophisticated reinsurer in the world.
Karn, before we wrap up, I'd be remiss not to ask you about the RE token, which went live pretty recently. What can you tell us about the RE token? What is the utility behind it? Just a quick sort of TLDR for folks that are trying to understand how does it fit into the protocol.
It's intended to emulate the Lloyd's Governance Council, right? So Lloyd's Governance Council stipulates who the acceptable counterparties are, what capital they need to post, and what economics they need to have at risk to be able to be aligned with the network, what fees are charged by that network to access the capital. And then ultimately the network, the Lloyd's market itself, is the market of last resort. So it absorbs tail risk and is compensated for that. The idea behind Lloyd's is exactly what drives the idea behind RE. It's just RE is built for the internet age. That's the difference. And instead of a governance council made up of sirs and knights, it is folks that hold RE governance tokens.
And then just remind us, Karn, if you can just recap, when again did the RE token go live? If someone holds the RE token, is there any staking they should take advantage of, or any other recommendations to basically maximize their usage of RE?
Yeah. So a lot of the functionality, voting on counterparties, etc., is about to happen. There is a staking mechanism, but this is in phases, right? We've got a client that's going to scale this thing to a couple billion in premium. We're going to bring on other counterparties and reinsurers that continue to scale it. And really it's when we're trying to assess who those folks are, the acceptability, the collateral that's necessary, what they're charged, that's when the RE governance token starts to really shine.
Karn, I think this is a great place for us to start to wrap up. We really appreciate you coming on. I think that RE is one of the best examples of fintech building that next generation capital stack using DeFi. And I think in a bear market, we badly need to hear these kinds of stories. This is the foundation, the bedrock of the next generation of on-chain finance. And it's just really cool to see how RE is bringing that all to life. So I want to remind our listeners, they can learn more about RE by going to re.xyz. They should follow RE, just RE on Twitter. That's the mothership handle for RE. And then follow Karn Saroya, just first and last name. That's Karn's personal handle. We'll put that all into the show notes. And then, yeah, Karn, we would love to have you back in the future. Keep up the great work building Re. And I want to give you the final word here before we go.
Yeah, for sure. Look, I really appreciate the opportunity to talk about my life's work. I think this is one of the biggest opportunities in DeFi. This is civilizational technology, right? It's like it enables risk-taking everywhere by folks who want to take risks and build things. It is only natural that it ends up on chain, and we're excited to do it.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.